What's up, fellow entrepreneur? It's PK Patel from Midwest Corporate Credit, where funding your business is our business. Hey, I just got done with a consultation with a potential client. This young man was looking for $250,000 to launch a startup company, and he wouldn't accept anything less. I told him that might not be doable because you haven't proven yourself yet. And this gentleman says to me, I have an 800 credit score. I should be able to get that $250,000. I'm not going to accept anything less. And I told him, well, yeah, the Cleveland Browns should be able to win a Super Bowl. So, but anyways, not to make fun of this gentleman, I want to break down why an established 800 credit score is completely different than a brand new 800. And I'm going to show you what the difference is, and I'm going to show you 5 factors that you need to focus on instead of the score itself. Alright, so let's dive into the credit report of our young entrepreneur friend. It says that he's got 802, 808, and 805 credit scores. Excellent credit by any standards. However, he's only got 2 years of credit history and he's only got 3 accounts. He's got a store card, he's got a student loan, and he's got an authorized user account that belongs to one of his parents that they let him use, which happens to report on his credit, which doesn't even count. Therefore, he's only got 2 years of credit history. Now, if he was to miss a payment or get a late payment, his 800 credit score on average would probably tumble down all the way into the 750 just by having one 30-day late payment because he doesn't have enough there. And therein lies a flaw in our FICO system. You can artificially have a high credit score just by having a short, excellent payment history. However, there's other factors as well. So now what we're going to do is we're going to take a look at another credit report from another client that is a little bit older, in his 40s, and he's got also 799, 802, 805 credit. Very, very respectable scores. Excellent payment history. He's never missed a payment before in his entire life. However, he's got 20 years of credit history, 16 accounts, 2 paid off mortgages, and ton of car loans that were paid off, and he's got 7 or 8 open credit cards with close to 0 balance. He pays them off every single month. So this 800, if he was to get a 30-day late, his score might only be impacted maybe 5 or 10 points as opposed to 50 or 60 of our young entrepreneur friend. So as you could see, there's a lot of other factors that matter when it comes to credit score. Next, we're going to cover what factors these are and what to look for instead of the actual credit score. All right, so what are the 5 factors that you want to pay attention to inside of the credit score? Let's go through them one by one. Number 1 is payment history. Number 2 is amounts owed. Number 3 is length of credit. Number 4 is types of credit. And number 5 is new credit / inquiries. So let's go over all of these one by one and give you some pointers on how you could improve in every single category. All right, guys, first factor is payment history. This one is pretty self-explanatory. Basically, don't make late payments. The top 2 tips I could give you is don't buy stuff that you can't afford to pay back, and second tip is set everything on auto pay. I know back in the day when everything used to be done by paper checks, payments would get lost in the mail and you'd get hit with a late payment. You wouldn't even know it until they sent you a late notice. Well, now that's not an excuse in the digital age. You could set everything on automated payment and not even have to worry about it. So that's what I would do if I were you. And keep in mind, if you do happen to miss a payment, it's going to have a diminishing impact, which means that as time goes on, it's going to have less of an impact. A late payment that happened 4 years ago is going to have less of an impact on your score than something that happened last month. Next factor is amounts owed. Basically, what this means is how much balance do you carry on your personal credit cards and how much do you have left on your installment loan. So the number 1 tip I could give you is do not ever go over your credit limit. Let's say you have a $10,000 credit card. Do not put any more than $10,000 on it. As a matter of fact, keep it as low percentage leverage as possible. Keep it under $3,400 in balance if you're able to. The other tip I could give you is if you're able to make weekly payments instead of monthly payments, it's even better. Why is that? Because keep in mind that your bank only reports to the credit bureaus once a month, which means, let's say they report on the first of the month. If you make 4 payments and never let your balance exceed, let's say $2,500, the credit bureaus are never ever going to know that there was more than a $2,500 balance on it, as opposed to making monthly payments. Let's say you make monthly payments. What will happen is you could get caught on the wrong side of that reporting cycle. Let's say you make payment on the 2nd of every month, but it reports on the 1st. What will happen is it'll show a $9,000 out of a $10,000 balance, which will show the card is 90% leveraged, as opposed to never exceeding the $2,500 mark. So that's a clever little trick that we teach to all of our clients in order to enhance their standing in this particular category of the FICO algorithm. Next up is length of credit. This is a measurement of when your oldest account was established. And if that account is closed, when was it open? So basically when your credit profile was established with the credit bureaus, that's what length of credit measures. As far as tips go, there isn't a whole lot I could tell you. I know there's all sorts of things that are out there on the internet, authorized user, trade lines, things that you could buy. I highly recommend you stay away from it. And one thing I would recommend is if you have a friend or a relative that you know is extremely responsible with their finances, ask them for a favor and have them add you on as an authorized user, and hopefully that'll get you some history. However, it's not always a guarantee, at least not on the business side. There's no guarantee that the underwriter is not going to just take that out completely and not count it and not give you credit for that history. So keep that in mind. What I would recommend is if you're young and you're watching this, establish your credit profile as soon as you can. Even if that means getting a $100 Macy's or a JCPenney or one of these retail store cards, go ahead and get it. It's gonna start building your history, and in the long run, the older you is gonna thank the younger you. Next factor is inquiries and new accounts. I'm gonna break this down into 2 subcategories. I'm gonna do new accounts and inquiries. Definitely new accounts are more harmful to your credit than inquiries are. Inquiries are eventually going to drop off your credit score, and they're going to have a diminishing impact as time goes on. So it's not a big deal if you get an inquiry or 2, although you want to keep both at a minimal. And if you're brand new at building credit, then you want to build it gradually and not just go out and shotgun out and open a whole bunch of brand new accounts, because what's going to happen is your credit score is going to take a dive. Also, if you're going to just open one account, make sure you only incur one inquiry. For example, when you go to the dealership, they're going to shotgun out your application for a car loan to 5 or 6 different lenders. You're only going to get one loan, but you're going to have 5 or 6 different inquiries. Sometimes I've seen clients go to car dealerships and get up to a dozen inquiries. So you want to be cognizant of that. If you are able to, go to your own credit union or bank and get that car loan pre-approved, so that when you go to the dealership, you already know who you're going through. You already know you're pre-approved for a loan, and who knows, you might be able to get a better deal on that car. But good luck with that. That's not my area of expertise. So we'll move on to the next topic. The last factor that you want to pay attention to is types of credit. Basically, you want to have a diversified set of credit accounts. You don't want to just have credit cards, or you don't just want your mortgage reporting to your credit report and nothing else. You want mortgages, installment loans, auto loans, and credit cards. So make sure you have a good mixture of all of them. Now, don't go out and open stuff up because you want to satisfy this sector of your credit. That doesn't make any financial sense either. However, just in the back of your mind, be cognizant of what you have reporting on your credit and where you're lacking, and next time you're shopping for something, for example, let's say you have no installment loans and you're going to go to the store and buy something. If they have an installment plan, get on the installment plan as opposed to opening up a store credit card, because now you'll get that check mark for an installment loan on your credit report. All right, my friend, that is all I have for you this week. If you enjoyed this video, give me a like, comment below, let me know you liked it, and also subscribe to our YouTube channel. For Midwest Corporate Credit, I'm PK Patel. Thank you for watching, and I'll see you next week.